All right, let's dive right in. Today, we're going to tackle a really popular but kind of tricky financial move, converting a traditional IRA over to a Roth IRA. We're going to break down one specific strategy based on a case study that shows how a financial product tries to solve the biggest hurdle of all, that giant tax bill.
I mean, who isn't, right? The idea of your money growing tax-free and then being able to pull it out in retirement, also tax-free, that's incredibly appealing. For a lot of folks, that's a huge long-term financial goal.
And here's the catch. To get your money from that traditional IRA into a Roth, you have to pay income taxes on the entire amount you convert, and you have to pay it in the year you do the conversion. That can be a really significant and honestly often a deal-breaking one-time expense.
So this brings us right to what's often called the conversion problem. How do you manage that massive tax hit without, shrinking the very nest egg you're trying so hard to grow?
It's really important to say this right up front. What we're about to walk through is a hypothetical example from a product document. This is not a prediction of the future. It's just an illustration of a concept. Our only goal here is to understand the mechanics of the strategy they're presenting. So, the solution that this case study proposes revolves around a specific type of annuity. Let's take a look at how it's all supposed to work. The main tool here is something called a fixed index annuity, or an FIA. The easiest way to think about it is this. It's an insurance product, not a stock. Its growth is linked to a market index like the S&P 500, so you get some of that upside potential. But the main feature is a guarantee that you won't lose your initial investment, your premium, even if the market takes a nosedive. And just for full transparency, the specific product they use in this hypothetical example is the North American Charter Plus 10 IFI. Knowing that is pretty crucial for understanding all the numbers and features that are about to follow. So the document lays out two totally different ways a person could go about this. First, scenario A is for tackling the entire tax bill immediately. Scenario B is all about trying to manage that tax hit by spreading it out over a few years. Okay, let's dig into this first option, what the document calls the full conversion. This is for someone who just wants to get the whole thing, the conversion and the tax bill, done and over with all at once. The case study kicks off with a nice, simple, round number, a traditional IRA with $100,000 in it that the owner wants to move over to a Roth. So, in this scenario, that conversion creates a taxable event right away. They're assuming a hypothetical 18% effective tax rate, which means an immediate tax bill of $18,000. Ouch! After you pay that tax bill, you're left with $82,000. And according to this strategy, that remaining amount is what you use as the premium to go and buy the fixed index annuity. Now, here is the absolute core of the strategy. The annuity in this example has an optional add-on. They call it a rider that gives you an immediate 23% bonus on your premium. It's really important to know, though, this bonus isn't free. It comes with an annual fee. So here's the key calculation. You take that $82,000 premium, you add the 23% bonus, and that brings the new account value up to $100,860. So in this hypothetical case, that bonus has completely wiped out the $18,000 tax hit and even left you with a little extra. All right, let's switch gears and look at the second scenario to see how it takes a different approach. This strategy is for somebody who really wants to avoid that single, huge tax bill and would rather spread out the pain over time. So the order of operations here is completely flipped. Instead of paying tax first, you use the entire pre-tax $100,000 to buy the FIA. Then that 23% bonus gets applied, which immediately boosts the account value to $123,000. And from that bigger pot of money, the owner can then start converting chunks over to a Roth over the next few years. And this really lays out the whole idea of a partial conversion perfectly. Instead of one massive taxable event, you break it down into smaller, more manageable pieces. By converting smaller amounts, like say $25,000 in year 1 and year 2, the owner might be able to stay in a lower tax bracket. They get to control the timing and the size of the tax bill, and then convert the rest whenever it makes the most sense for them.
Okay, with any financial strategy, especially one you see in a marketing document, the details in the fine print, well, they're everything. So let's take a second to look at the key disclosures and the trade-offs that are mentioned in this source. This quote right here from the source document is incredibly important. It really explains the fundamental trade-off. That upfront bonus isn't just free money. It might come at the cost of lower potential interest credits over the life of the annuity. And over time, that could end up offsetting the initial benefit of the bonus.
The document also points out several other critical things to know. That rider that gives you the bonus, it has an annual charge of just under 1%. It also states that this charge could, in certain situations, cause you to lose some of your premium. And of course, it hammers home that this is all hypothetical and that you should absolutely talk to your own tax professional for real advice.
So if we boil it all down, the strategy that's presented in this document is all about using one specific feature of a financial product, that upfront premium bonus, as a tool to potentially cancel out one of the biggest drawbacks of a Roth conversion, that immediate tax bill. And, that really brings us to the central question this whole strategy raises for any of us. You're looking at a trade-off, an immediate, very real benefit, getting rid of a big tax bill, in exchange for potential costs down the road, like annual fees and maybe lower long-term growth. So the question you have to ask yourself is, what are you really optimizing for? And what trade-offs are you willing to make to get there?